Over the weekend, Spirit Airlines abruptly canceled all future flights. Travelers arriving at the airport found covered kiosks and a digital notice confirming that customer service was no longer available. The shutdown left 50,000 passengers stranded and approximately 17,000 employees facing immediate job losses as the carrier began an orderly wind-down of its business. This wasn't a sudden failure of a healthy company. Spirit had been navigating bankruptcy protection since August 2025, but the recent fuel price spike linked to the conflict in Iran acted as the final catalyst that forced the airline into total liquidation. When a company is already fragile, a shift in global geopolitics can transform a difficult restructuring into a terminal event. While this looks like a purely American story, the forces that ended Spirit Airlines are the same ones currently pressuring local stock portfolios in the Philippines. Every company has a specific level of input cost vulnerability. For transport and logistics firms, the price of fuel is an inescapable variable that connects local earnings directly to global shipping routes. To protect your capital, you have to trace how these macroeconomic shockwaves move through the supply chain before they show up in the Philippine Stock Exchange. To understand the math of the collapse, look at Spirit's restructuring assumptions. Their plan relied on jet fuel prices staying here $2.24 a gallon through 2026. This chart shows what happened instead. As strikes disrupted the Strait of Hormuz, global jet fuel prices doubled, reaching $4.51. For a bankrupt company, this was unsustainable. The surge drained Spirit's liquidity by $100 million, derailing their recovery. Global logistics and transport sectors are built on the assumption of predictable passage through these maritime choke points. When they are threatened, every business model that relies on heavy fuel consumption is at risk. If the underlying math of a business depends on cheap energy, a geopolitical event can destroy that company faster than any internal management team can react. The Trump administration considered a $500 million rescue deal that would have given the government a 90% equity stake in the airline. However, the bailout faced internal resistance. Transportation Secretary Sean Guffey argued that Spirit's model was broken long before the war, ultimately refusing to provide government funding for what he called a corpse. With the bailout off the table, the airline began a fire sale of its assets. Its fleet of 114 Airbus planes is now being liquidated to pay off creditors. As Spirit's stock value dropped by 25%, rivals like Frontier and JetBlue saw their shares rise by 10 and 4%. These competitors are already moving to absorb Spirit's customers and routes. The market reacts to failure with cold logic. A terminal vulnerability for one airline is viewed by investors as a growth opportunity for another. Identifying these risks early requires shifting from an emotional reaction to news headlines toward a clinical analysis of your portfolio's exposure. Many logistics and transport firms on the Philippine Stock Exchange share a common trait with Spirit Airlines. Fuel is one of their largest and most volatile operating expenses. These companies typically operate on narrow profit margins. When global oil prices stay high for an extended period, it compresses those margins regardless of how well the company is managed locally. The distance from the conflict doesn't matter. If a company's input costs are tied to the global energy market, they are vulnerable to the same shockwaves that ended Spirit. It is now essential to run a clinical stress test on your current holdings to see which ones can actually withstand a prolonged energy spike. Calculate how your held transport companies would perform if jet fuel maintains a price above $4.50. If the earnings hit is severe, the time to adjust your position is before the price breaks through the next resistance level. Successful trading relies on following data-driven rules rather than waiting for a crisis to settle. Subscribe for more in-depth analysis of how global events impact the Philippine market. And let us know in the comments, which sectors in your portfolio are most exposed to the current oil shock?